Well, the job market has been in utter chaos, and there's a lot of fingers pointing at a lot of different directions, but this little detail makes the most sense to me. You know why? Because this makes the numbers from the company's point of view of keeping a large payroll hired extremely expensive. So let's dive right in. I think this article really feels like a needle in a haystack, which gets to the bottom of why there has been a steady pattern of mass layoffs happening since early 2023. We said it was COVID, we said it was the boom of AI, and like COVID has dissipated. I think there's been a little bit of, steam letting from the AI hype, but the mass layoffs that have been happening around the tech industry has been marching on. Let's dive right in. Let's waste no time. So apparently there's a decades-old tax rule that helped build America's tech economy. We're going to get into how this particular tax code really helped innovation, specifically in the earlier era of Facebook, Google, your Microsofts in the early 1970s. But that changed with Trump's first term of presidency, and it's a very minor change that led to this massive numbers implication for tech companies. Excellent article by Catherine Bob. Let's get right into it. We're going to skim through it, and then we're going to talk about this particular tax code, the tax code 174, and how it's changed, which shocks tech companies so rigorously. So for the past 2 years, it's been a ghost in the machine of American tech. We all know that. Between 2022 and today, a little notice tweak to the US tax code, specifically 174, has quietly rewired the financial logic of how American companies invest in research and development. Right? So if you understand tax write-offs, if you're trying to start a business today, if you're trying to start an LLC, one of the benefits of just not going about and starting a business on your own and starting an LLC instead is that a lot of the expenses that you incur in the early days of business is not directly going to lead to profits, right? Because you're going to have to invest in startup costs. Maybe you buy some equipment to get your clothes making business off the ground and running. That huge upfront capital expense is not directly going to translate to profits in year one. That shouldn't deter you from starting a business. And in order for you to have some benefits and some incentives to go ahead and incur those startup costs anyway, you can write off these expenses as business expenses, and this is going to lower your tax bill, right? And when you think about tech companies, the biggest expense they have on their income statement, on their profit and loss statement, is the payroll that they're paying to their software engineers. And the tweaking of this specific tax code took that away from them. This article does, it's a great article. It reads, it reads really well like a novel, but it does kind of obscure the meat of what's going on until we get into the depths of the article. So let's get that out of the way. Let's understand what Section 174 of the tax code is, right? So Section 174 of the Internal Revenue Code governs the tax treatment of research and development expenditures by businesses, which again, for tech companies, most of the R&D, well, in the age of era, it's been CapEx investments in acquiring chips, GPUs from NVIDIA, but historically, it's been supporting the massive payroll that's dedicated to hire software engineers, data engineers, machine learning engineers. It's essentially hiring human capital. Its primary aim is to encourage innovation by providing favorable tax treatment for R&D costs. All right, let's look at the original treatment. When first enacted in 1954, so it dates way back the internet era, predates the internet era, Section 174 allowed businesses to immediately deduct R&D expenses in the year they were incurred, right? So if you hired 50,000 employees, software engineers, you could write off that entire expense as R&D for that very year. So when you file taxes for that particular year, you're going to see a massive reduction in the tax bill that you owe to the IRS as a business. Reducing taxable income and incentivizing investment in innovation. Look, at the end of the day, right, this is a large reason, this is a big reason for why these massive tech companies are so open to taking on a lot of expenses and staying unprofitable for years and years on end. Amazon, the reason it was able to grow so much is because it had invested heavily, it reinvested its profits into growth, into growing its businesses, into buying new equipment, into getting into new areas of innovation, and intentionally staying unprofitable for many years, which reduced its tax bill significantly, right? For for this reason, and also because it wasn't making a profit, you are taxed on the profit. You could actually benefit from a tax point of view if you're incurring losses. Let's get into it. What happened in recent years that took away this advantage from tech companies? Post Tax Cuts and Jobs Act of 2017, during the Trump era, significantly changed Section 174 for tax years beginning after December 31st of 2021, which kind of coincides to the massive layoffs that started happening. Businesses can no longer immediately deduct R&D expenses. Instead, they must capitalize and amortize these costs over 5 years for domestic research, over 15 years for foreign research. So amortization basically means you take this expense, you break it up over multiple years, right? So instead of taking the expense associated with hiring those 50,000 engineers in year one, you break up that expense over the next 5 years. Now, this makes sense for, like I think if you're if you're trying to gain immediate benefits for a big expense like that, this isn't as lucrative. So you only get the tax benefits of hiring 10,000 employees for that particular year. So at that point, having a large expense like hiring a lot of people in a given year almost is a expense and a liability that you can't really swallow down. What qualifies Section 174 expenditures? Okay, so mostly R&D, but let's break it down. Let's get to the line items level description of what qualifies these expenses. Wages, again, this is the biggest expense for most tech companies. Supplies and materials, which probably are NVIDIA chips for now. Patent costs, software development. I'm assuming this is software development that's offloaded to contract workers, but anyway. And you have utilities, equipment, stuff like that. For tech companies, it is mostly wages, employees that you hire on payroll. Let's get back into the article. So all that changed. Still, the delayed change to a decades-old tax provision buried deep in 2017 tax law. Again, like 2017, the Tax Cuts and Jobs Act tax law that was enacted made this change, contributed to the loss of hundreds of thousands of high-paying white-collar jobs. This is also something that really spooked the market. Usually when you have layoffs, right, they happen at the blue collar level, but the layoffs that started around 2021 started happening at the white collar level. In fact, in the ecosystem of a tech company, I would argue that engineers are as close to blue collar as it gets because they are close to the quick and dirty work, the dirty engineering that builds the products, and then you have like the product managers and engineering leaders and directors who are the truly blue collar employees. And this affected mostly white collar jobs. It also affected engineering, obviously, but you're going to see a disproportionate amount of non-engineering jobs get affected in a lot of layoffs that have been happening today. That's the picture that emerges from a review of corporate filings, public financial data, analysis of timelines, and interviews with industry insiders. One accountant working in-house at a tech company described it as a niche issue with broad impact. You also see these unnamed insider folks working at these tech companies name this particular tax code 174, as the main culprit for initiating these mass layoffs. Echoing sentiments from venture capital investors also interviewed for this article. So this wasn't just your company insiders, your publicly traded companies, their accountants and insider folks that are blaming a large part of the mass layoffs on this tax code. You also have venture capital investors share the same sentiment. Since the start of 2023, more than 500,000 tech workers have been laid off. We know that. We've been keeping our eyes on how terrible this journey's been. And we've had a lot of things to blame our fingers, to cast blame on. Overhiring during the pandemic, which did happen, and it did contribute to some extent on the massive and aggressive layoffs that followed. AI has been another thing that we've been using as a punching bag for mass layoffs. But again, Section 174 is really what spooked the tech companies. This is what threatened their bottom line. This is what threatened the benefits that they were seeing by immediately being able to write off R&D expenses same year. So there is a bipartisan effort right now to repeal the change made to Section 174, but this is going to take a lot of time. This is going to take a lot of time, and in the meantime, I think the market is still going to react pretty adversely to by conducting mass layoffs. A tax break that built the modern tech economy. Let's just quickly do a deep dive into how we built up the tech industry in the wake of the tech boom in the early 2000s. For almost 70 years, American companies could deduct 100% of qualified research and development under Section 174 spending in the year they incurred the cost. Salaries, software, contract, or payments. If it contributed to creating or improving a product, it came off the top of a firm's taxable income. Very lucrative. The deduction was guaranteed by Section 174 of the IRS Code of 1954. Under the provision, R&D flourished in the U.S. Microsoft was founded in 1975, so one of the first beneficiaries of the 1954 Section 174 of the IRS Code. Apple launched its first computer in 1976. Google incorporated in 1998. It's such a baby. Facebook opened to the general public in 2006. All of these companies, now among the most valuable in the world, developed their early products, programming tools, hardware, search engines under a tax system that rewarded building now, not later. So that's that's just something to think about. You realize that at the end of the day, markets react most strongly when the numbers are threatened. And this is almost a direct piece of logic that affects how much expenses you're able to shave off of your tax bill. And specifically for companies that are publicly traded, that's all they care about. At the end of the day, companies that are publicly traded have one purpose and one purpose alone, and that is to increase shareholder value. That is to reduce their costs and become as profitable as they can possibly be. For the longest time, tech companies have resisted being profitable by investing in innovation and growing so that they can remain unprofitable in a way that benefited their tax bills, but that is no longer the case. Now they have to amortize the R&D expenses that they incur in a given year over 5 to 15 years. So all of a sudden, that's not all that lucrative. And that takes aim at the biggest R&D expense at tech companies, payroll for their engineers. Anyway, I hope that was insightful. It definitely opened my eyes to what really is the underlying cause for these mass layoffs going around all industries and all tech companies, even tech companies like Twilio that aren't directly invested in a lot of AI-powered research and automation. Thanks for watching. I'll see you in the